Welcome to Charged Alpha. I'm Hudson Thomas, joined by Lana Chen. Today's company chapter, Sterling Infrastructure.
Sterling Infrastructure builds the physical foundation of the modern economy: roads, bridges, heavy concrete structures, and now massive data center campuses across the country.
The company was founded in 1955 in Texas. For 6 decades, it operated as a steady regional contractor, building transportation infrastructure quietly across the American South.
In 2019, Sterling made its defining bet. It carved out a new e-infrastructure division dedicated entirely to pursuing the rapidly growing data center construction market.
That pivot proved perfectly timed. Hyperscalers like Amazon, Microsoft, and Google are now pouring concrete at a scale that requires Sterling's specialized civil expertise.
Q1 2026 revenue came in at $826 million, up 91.6% year over year. That growth rate is not a one-quarter anomaly. It reflects structural AI demand.
Earnings per share landed at $3.59 versus the $2.29 estimate. That is a 57% beat, a number that gets Wall Street's full and undivided attention.
Gross margin held at 23.5%. That is solid for heavy civil construction, where materials and labor make margins difficult to protect at this pace of growth.
Free cash flow hit $145.9 million on a trailing basis. Sterling is converting revenue into real cash efficiently, which funds expansion and keeps the balance sheet strong.
The balance sheet is unusually clean. Sterling carries $511.9 million in cash and essentially zero long-term debt, a genuinely rare combination for any construction company.
The backlog stands at over $3.5 billion, more than a full year of current revenue. That gives management exceptional visibility into the workload ahead for planning purposes.
Sterling operates across 37 states. It is the pick and shovel play for AI infrastructure, doing the civil groundwork before electrical or mechanical systems can even begin.
2 major policy tailwinds are running simultaneously. The IRA and CHIPS Act fund manufacturing site work. The Infrastructure Investment and Jobs Act supports transportation contracts nationwide.
The key risks are project lumpiness and input cost volatility. A delayed permit or a concrete price spike can push margin dollars from one quarter to the next.
That 91.6% growth rate also sets a brutal comparison base going forward. Sustaining that pace is essentially impossible, and the market will eventually need to recalibrate.
CEO Joseph Coutinho joined Sterling as CFO in 2015 and moved to the top role in 2016. His finance-first background has shaped a disciplined, margin-protective capital approach.
Coutinho's strategic focus is straightforward: grow e-infrastructure aggressively while protecting margins. The backlog and the zero-debt balance sheet are the proof points of that discipline.
The stock went from roughly $8 in 2020 to over $529 today. That massive re-rating reflects a transformation from a regional contractor into a high-growth infrastructure platform.
The single most important metric to watch is the backlog number. Data center contract updates will tell you whether the AI build-out cycle is still accelerating or cooling.
Sterling is literally pouring the concrete foundation of the AI economy, one slab at a time. We will be watching the backlog. That is your Charged Alpha chapter on Sterling Infrastructure.
Sterling Infrastructure just handed Wall Street a reality check. The company no one was watching posted the kind of earnings that make analysts scramble to update their models. Revenue up 91% year over year. EPS beat by nearly 57%, and the stock is already trading well above the average analyst price target. This is Charged Alpha. I'm Hudson.
And I'm Lana. Sterling Infrastructure is a Texas-based construction and engineering company with 3 business segments. E-Infrastructure Solutions handles the heavy civil work for data centers, grading, utilities, and site preparation. Transportation Solutions builds and rebuilds roads, bridges, and highways. Building Solutions covers residential concrete work across the Sun Belt.
The company has been on a quiet transformation. 3 years ago, nobody talked about Sterling. Then hyperscalers started breaking ground on data center campuses at a pace no one anticipated, and Sterling's e-infrastructure division was positioned exactly where the picks and shovels money needed to go. Market cap is now $13.8 billion, and the stock is sitting around $529 a share.
Let's get into the Q1 2026 numbers because they are genuinely striking. Revenue came in at $825.7 million. The street was expecting $603.6 million. That is a 36.8% beat on the top line in a single quarter. Year over year, that is 91.6% growth. Those are not rounding errors. That is a company operating in a different gear than its peers.
On the bottom line, GAAP earnings per share printed at $3.59 against a consensus estimate of $2.29, a 56.8% beat on EPS. Gross margin came in at 23.5%, which is healthy for a construction business. Net margin hit 11.6%. These are the kinds of margin profiles you do not usually see in heavy civil work.
Free cash flow was $145.9 million in the quarter, representing a 17.7% free cash flow margin. Cash on the balance sheet is $511.9 million. And here is the part that makes the balance sheet story even cleaner: zero debt. Sterling is carrying no long-term debt while printing nearly $150 million in quarterly free cash flow.
The revenue trajectory tells the story clearly. Q1 2025 was $430.9 million, Q2 was $614.5 million, Q3 $689, Q4 $755 points, and Q1 2026 lands at $825.7 million. 5 consecutive quarters of sequential growth, and the acceleration is coming from one place.
That place is the E-infrastructure segment. Data center construction has become the dominant driver. Hyperscalers, think Microsoft, Amazon, Google, Meta, are all racing to build out AI compute capacity, and that requires enormous amounts of civil infrastructure work before a single server rack goes in the ground. Sterling is one of the few firms that can execute at this scale, which is why backlog keeps growing.
At 4.8 times PS, you are paying up for a company in a cyclical industry, but the growth rate justifies the conversation. The IRA and CHIPS Act are also generating a separate layer of infrastructure demand in the transportation segment. Sterling is not a one-theme story, but the data center build-out is clearly the main event heading into the rest of 2026.
The analyst community has a consensus buy rating on Sterling, but there is an interesting wrinkle. The average price target is $390. The stock is trading at $529. That means the stock is already trading nearly 36% above where the median analyst thinks fair value is right now.
That gap tells you something. Either analysts are behind the curve and need to revise targets materially higher after this print, or the market is pricing in a level of future growth that has not yet been demonstrated in the numbers. Probably some of both. After a beat this large, you should expect a wave of target price upgrades over the next 2 to 3 weeks.
The bull case from the sell side centers on backlog visibility. Sterling's management has been guiding to sustained demand from hyperscalers through at least 2027. When you have signed contracts or letters of intent from the largest technology companies in the world, revenue visibility is meaningfully higher than it would be for a typical infrastructure contractor. That supports premium valuation.
The skeptics on the street point to the PS multiple and ask what happens if hyperscaler CapEx plans get revised down. Microsoft and Meta have both signaled large multi-year commitments, but capital allocation decisions at tech companies can shift faster than a multi-year construction project can be unwound. That is a real risk factor embedded in the current price.
There is also the lumpiness question. Construction revenue is project-based. A quarter where a large project starts site preparation looks very different from a quarter between project milestones. Q1's 91% year-over-year growth is extraordinary, and the street will be watching carefully to see whether Q2 and Q3 sustain that momentum or whether some of it was timing-driven.
The bull case for Sterling starts with structural demand. AI infrastructure build-out is not a 1 or 2 quarter story. The hyperscalers have publicly committed hundreds of billions of dollars in data center CapEx over the next 3 to 5 years, and that work has to be done by someone. Sterling is already embedded in those supply chains with a proven track record at scale.
The balance sheet supercharges the bull case. Zero debt and over $500 million in cash means Sterling can pursue acquisitions, take on larger project bids, and weather any slowdown without existential risk. That financial strength also gives management flexibility to return capital if growth opportunities moderate. It is a genuinely fortress balance sheet for an infrastructure company.
The picks and shovels framing matters too. You do not have to predict which AI model wins or which hyperscaler gains market share. You just have to believe that large-scale data center construction keeps happening, and Sterling captures a portion of that spend. That is a lower conviction required thesis than betting on a specific technology outcome.
The bear case has several credible legs. First, project lumpy revenue. When Sterling finishes a major data center campus and the next one has not yet broken ground, quarterly comps can get ugly fast. The Street has already seen this dynamic play out at other specialty contractors. The 91% year-over-year growth in Q1 sets a very difficult comparison for Q1 2027.
Second, the valuation is stretched against analyst targets. At 4.8 times trailing revenue with the stock 36% above the average price target, you need everything to keep going right. A single guidance cut or project delay could reprice the stock quickly. High multiple stocks in cyclical industries have a well-documented tendency to overshoot in both directions.
Third, hyperscaler CapEx sensitivity. If any of the big spenders, Microsoft, Amazon, Alphabet, Meta, announce a pause or reduction in data center spending, Sterling's backlog growth story unravels at least temporarily. We saw a version of this dynamic in early 2023 when cloud spending decelerated sharply and infrastructure-adjacent names sold off hard.
And fourth, competitive pressure is building. As data center construction has become a lucrative market, larger engineering and construction firms are moving aggressively into the space. Quanta Services and EMCOR are both sharpening their focus on digital infrastructure. More competition could compress Sterling's margins over time, even if the absolute volume of work stays high.
Let's put Sterling in context against its peers. Quanta Services, ticker PWR, is the largest electrical contractor in North America, with a market cap north of $40 billion. Quanta posted revenue growth of just 0.4% in the most recent quarter, and trades at 1.6 times price to sales. Sterling's 91% growth versus Quanta's near-flat performance in the same macro environment is a dramatic contrast.
EMCOR Group, ticker EME, is another direct peer, mechanical and electrical construction across commercial, industrial, and institutional markets. EMCOR grew revenue 2.5% and trades at 1.2 times PS. Again, Sterling's growth rate and its 4.8 times multiple reflect a completely different business trajectory. The market is paying a data center infrastructure premium.
Mastech, ticker MTZ, rounds out the peer set. Mastech actually posted negative 2.8% revenue growth and trades at only 0.6 times price to sales. Mastech is more telecom and pipeline focused, which has been a tougher environment. Compared to all three peers, Sterling's growth profile is in a completely different league this quarter.
The valuation premium is real, and it is justified by growth, but it requires that growth to persist. Quanta, EMCOR, and Mastech all trade at deep discounts to Sterling on a price-to-sales basis because their businesses are growing in the low single-digit range or contracting. If Sterling's growth rate normalizes toward the peer group, the multiple compression would be meaningful.
The options market is leaning constructive on Sterling. The put-call ratio is below 0.7, which is a bullish signal. When fewer puts are being bought relative to calls, it typically indicates that options traders are more interested in upside participation than downside protection. That skew is consistent with the broader data center construction theme driving institutional call buying activity.
The call activity is concentrated around the data center thesis. Traders buying calls tied to hyperscaler spending announcements and contract wins. When options flow aligns with a specific fundamental catalyst rather than speculative noise, it adds confirmation to the thesis. The options market is voting that the e-infrastructure story continues to compound.
On the insider side, the picture is more muted. There have been no open market purchases from executives or directors in the recent filing window. What we have seen is executive option exercises, insiders converting existing grants into shares, which is standard compensation-driven activity rather than a signal of conviction. It is not a negative, but it is also not the kind of insider buying that would add a strong confirming signal.
When insiders are not buying on the open market, even as the fundamental story accelerates, it is worth noting. Executives likely have significant exposure through existing option grants and restricted stock, but the absence of open market purchases at these prices is a mild data point to keep in mind alongside the bullish options flow.
Sterling is one of the most direct picks and shovels plays on AI data center construction. Q1 numbers were exceptional. 91% revenue growth, a 57% EPS beat, fortress balance sheet, zero debt. The core thesis is intact and stronger than it was 90 days ago.
The caveat, the stock is priced for perfection, 36% above analyst targets, 4.8 times sales. Size with the volatility in mind. This one moves hard on any hyperscaler CapEx headline.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.